Welcome back to Alpha Recap, your end-of-day market rundown from stockalpha.ai. Energetic day to unpack. Markets closed lower after an inflation surprise shook rate expectations. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. What really stands out here is how one print rewired the whole tape. It was a pretty broad reset.
Totally. Starting with the headline, April consumer price inflation came in at 3.8%, a near three-year high. That number pushed traders to reprice rate risk and sent benchmark Treasury yields toward the 5% neighborhood.
Yeah, that tracks. And that move mattered everywhere. Pre-market futures and broad ETFs slipped, and by the close, the tone had stayed cautious across the board.
Right. To put it simply, higher inflation pushed yields up, and higher yields compressed present values for long-duration cash flows. Growth names felt the pain more than the rest, while some parts of financials actually got a look.
Analysts really keyed in on that rotation. Fifth Third got positive attention, in part because it traded at a forward price-to-earnings ratio of about 12. Meanwhile, Charles Schwab lagged. It was around $89.40 and had underperformed over the last 6 months, down about 6.5%, while the S&P finished that span up about 7.7%.
And that contrast highlights the point. Higher rates can be a tailwind for some banks because steeper curves often lift net interest margins. But broker-dealer models like Schwab face different flow and platform issues when investors pull back from riskier assets.
Exactly. Another big theme, and this one is nuanced, is AI as a two-edged sword. Cisco previewed accelerating AI-driven data center demand into the third quarter, which supports an infrastructure growth narrative. But at the same time, we saw reports about abrupt layoffs at General Motors linked to AI and severance decisions. So AI is both CapEx for some and a cost cutter for others.
When you step back and look at this, it creates winners and losers depending on the company's role in the AI value chain.
Right. And the other thing is that the market is fragmenting. Sector leadership is fragmenting. We saw dispersion across tech, financials, consumer names, and semiconductors.
Let's dig into a couple of the company stories that moved the tape today. Pfizer reported lower first-quarter net income, but still has a dividend yield around 6.7%. Analysts are debating payout sustainability given the profit drop and pipeline needs.
Yeah, dividend durability is getting discussed a lot. The headline yield looks attractive, but analysts note you need to assess free cash flow coverage and the cadence of drug revenues. So opinions were mixed on whether that yield is safe going forward.
On the consumer side, On-Holding topped first-quarter expectations thanks to strong China demand, while Nike showed some lag. Geographic exposure clearly mattered today.
And another cross-sector stat that got attention. Airfares were up about 21%, with specific routes seeing increases as high as about 40%. That's inflation that feeds through into corporate revenues and travel, but it also pressures consumer wallets.
Let's talk one micro story that really illustrates market mechanics. Poet. The name printed about $14.26 in the session after a nearly 20% move the prior day, and it's roughly 265% off its April low of $3.87.
Poet is basically an options flow case study. The options chain showed concentrated open interest through the May 15th expiration, about 20,300 contracts at the $15 call, plus big positions at $18, $20, and $25. When open interest piles up near a strike, dealers hedging can amplify moves.
Let me unpack that simply. When dealers sell calls, they hedge by shorting the underlying as the price rises to stay delta neutral. That shorting can push the stock higher, which forces more hedging, a feedback loop. Analysts pointed to the next few trading days into the May 15th expiration as pivotal.
Yep, and the debate was alive. Was Poet just spot momentum, or was there a classic gamma squeeze forming? Some say momentum, others warn the concentrated short-dated calls could trigger dealer flow that materially amplifies volatility.
Quick reactions. Big move.
Not what anyone expected.
Let's return to the macro thread. Why does 3.8% CPI matter? Analysts said it breaks a multi-year downtrend and pushes policy-sensitive thresholds. It elevates break-evens and term premia, prompting reallocations away from rate-sensitive assets.
Higher yields, especially the move toward 5% Treasuries, compress the present value of future cash flows. That's why long-duration growth got hit, and value in some financials got a fresh look.
Honestly, I was a bit surprised by how immediate the repricing was. Pre-market action already showed ETFs and futures slipping. That set the tone for the day.
Yeah, and then overlay geopolitical energy pressure, coverage tied it to tensions around Iran, and you get an inflation narrative that's part structural and part supply shock.
On semiconductors, the technicals added noise. South Korea's Kospi printed a key reversal that made some technical analysts nervous about chips. Others pushed back, saying fundamentals, like AI silicon demand, provide a more differentiated view across chip subsectors.
So there's a split. Technical signals raise red flags, but secular demand for AI infrastructure is still a strong argument for certain suppliers.
For different investor types, the implications were pretty clear today. Income investors got drawn to headline yields like Pfizer's, but analysts cautioned to look beyond the nominal number and evaluate durability.
Value and quality investors got a reminder to reassess financials. Some regional banks might look interesting on valuation, but rising rates also raise credit risk considerations for banks reliant on wholesale funding.
Growth investors had to wrestle with higher discount rates. But Cisco's preview kept a portion of the tech complex's narrative alive by pointing to durable data center spending tied to AI.
Traders and options players had a clear event in POET. Short-dated clustered open interest creates gamma risk. Analysts said dealer hedging could exacerbate moves when strikes are breached.
Internationally, India's inflation was rising for a sixth straight month, but still came in below estimates, which suggests a nuanced outlook for its central bank. Globally, commodity-driven inflation, energy, was the immediate channel affecting yields and cross-asset positioning.
Let's hit the strategic considerations. Informational only. First, reprice duration exposure. That CPI print and the move toward 5% Treasuries mean it makes sense to stress test cash flow assumptions under higher discount rates.
Second, watch derivative expirations and clustered open interest. POET is the cautionary tale that short-dated positioning can create idiosyncratic volatility.
Third, segment the AI story. Distinguish CapEx beneficiaries like networking and data center suppliers from firms using AI as a headcount or cost lever.
Fourth, reassess income sources in a higher yield world. With headline yields ticking up, the comparative case for equities as income sources changes. Payout sustainability matters here.
Fifth, prepare for volatility and dispersion. Higher inflation and geopolitical uncertainty increase the probability of cross-sector divergence and more frequent single-name shocks.
Short reactions, wow.
Big day, big headlines.
Before we wrap, a couple of quick clarifications analysts emphasized. 1. Headline yields aren't everything. For dividends, you need to look at free cash flow and the business model. 2. Options-driven moves can be transient but disruptive. Traders need to watch gamma and liquidity.
And 3. AI demand is structural but uneven. Some companies will see durable revenue and margin improvements. Others will use AI to cut costs. It's not one size fits all.
Final takeaways. Inflation surprised to the upside at 3.8%. Yields moved toward 5%. Markets closed lower, and that repricing drove sector rotation and heightened dispersion. POET showed how derivatives mechanics can create outsized moves, and company-level stories ranged from Pfizer's dividend questions to Cisco's AI demand signal and layoffs tied to AI at General Motors.
Analysts broadly agreed that inflation repricing was the dominant market engine. They agreed AI demand for infrastructure is real, and they agreed sector dispersion is intensifying. But they diverged on things like POET's squeeze potential, Pfizer's payout durability, and the short-term outlook for chip names.
All right, that's our wrap. If you want a quick recap of the highlights, we'll post show notes and links at stockalpha.ai.
And if you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening to Alpha Recap. We'll be back after the next session to synthesize what moved markets. Stay curious and informed.